Welcome to this explainer on diagnostic cost accounting. Look, today we're going to treat cost accounting a little differently than you might be used to. I want you to completely step into the role of a financial physician. Because when you're looking at an inventory holding business, you aren't just tallying up numbers or checking off some compliance list. You are diagnosing the fundamental health of the entire operation. So put on your stethoscope, focus in, and let's get ready to master the inventory cycle. Okay, I've got a really serious question to kick things off. Are your clients' standard costs actually hiding a massive financial disaster? I know it sounds a little dramatic, right? But honestly, if you treat cost accounting like basic everyday bookkeeping, you are missing the biggest risks in the business. An outdated standard cost isn't just a tiny typo. It completely distorts gross margins, it ruins pricing decisions, and it can artificially inflate the balance sheet until the entire financial reality of a company is warped. To fix these issues, we need a roadmap. We'll start with the examination, move into spotting the symptoms, then treating the failures, looking at preventative care, and finally wrapping up with the health plan. Let's dive right in. Section 1, the examination, the 5-step advisory method. This is where we take the initial pulse of the business. Anybody can keep adequate books, but true advisory value, the kind that literally saves a business from going under, comes from mastering this universal 5-step method. And the best part, you can repeat this for any inventory client. Step 1, you figure out if they're a trader, a discrete manufacturer, or maybe they're using process costing. Step 2, check their landed cost policy. Does a supplier invoice plus freight plus duties actually equal their true inventory value? Now, steps 3 and 4, this is where the magic really happens. You pull the standard cost cards for their top 5 products, assess their predetermined overhead rate, and really dig into those monthly variance reports. If those variances are just being dumped into cost of goods sold without any real investigation, that is a massive warning sign. And finally, step 5 is your safety net, reconciling the subledger to the general ledger and assessing overall valuation. The beauty of this examination is how well it flexes based on the actual business model. You wouldn't apply the exact same diagnostic to a local clothing retailer that you would to a massive chemical plant, right? For a trading or retail business, you completely ignore manufacturing overhead. Instead, you laser focus on landed cost, complexity, and valuation challenges, especially for fashion or perishables. But if you're looking at batch or process manufacturing, your focus shifts entirely. You're looking at equivalent unit calculations, yield variances, and whether they are correctly separating normal spoilage from abnormal spoilage in their standard bill of materials. Moving on to Section 2, spotting the symptoms, red flags to watch for. Okay, so our baseline examination is done. Now it's time to play detective. What actually happens when the financial nervous system of an inventory business begins to break down? Well, if you see freight and duties being expensed instead of properly capitalized, that means the standard material cost is incomplete. It severely undervalues the inventory and warps the gross margin across all periods. What about standard costs that haven't been updated in over 12 months? That tells you every single variance you're looking at is measuring the gap from a completely obsolete benchmark. It makes product pricing totally unreliable. And if variances are just disposed of without any investigation whatsoever, that means the client is using cost accounting purely as a bookkeeping chore, not as a management control tool. The root causes of their bleeding margins are just never being addressed. Section 3, treating the failures, real-world case scenarios. We spotted the symptoms, but now we have to jump in and act like the lead advisor. Imagine this terrifying real-world scenario. Let's call it Case C. You walk into a client's facility, a physical count is done, and boom, there's a 15% shortage of inventory. Worse yet, there is zero ongoing cycle count program in place. What do you do? Because a 15% gap means one of two very alarming things. Either there is systematic theft happening right under their noses, or there are 12 straight months of massive counting and recording errors that went entirely undetected. So the absolutely crucial point here is this. Do not immediately adjust the books. Doing that just sweeps the whole disaster under the rug. First, you recount a representative sample using completely independent teams. Next, you investigate, was it a timing issue with receipts or genuine shrinkage? Then, you implement an ABC cycle count program immediately, making sure you're counting those highly valuable A items on a monthly basis. Only after all of that do you post a confirmed adjustment with full documentation. And hey, if it points to theft, you engage management and potentially even law enforcement. Now, consider cases A and D. What happens when inbound freight is mistakenly expensed and machine spoilage is wrongfully capitalized? I know, these sound like everyday, minor clerical errors, right? But they are actually financial diseases that silently misstate period income and completely inflate asset values on the balance sheet. The treatment for these has to be highly decisive. For expensed freight, you must update that landed cost policy and correct all standards to full landed cost. But be warned, correcting this standard is going to produce a one-time, unfavorable material price variance. Now, for capitalized spoilage, you've got to separate it into normal spoilage, which is expected and already built into the bill of materials, versus abnormal spoilage. Abnormal spoilage has to be expensed immediately as a loss. If you don't do this, the products appear way more expensive than they actually are, and those inventory balances just artificially inflate. Keep in mind, if these accumulated errors are large enough, correcting them might even require a full restatement under standard accounting rules. Let's look at Case B. This brings us to the predetermined overhead rate, or POR. The POR is essentially the yardstick for measuring overhead absorption. But here's the massive trap. If a client builds their POR on 100% theoretical capacity, basically acting like the factory runs flawlessly 24/7, while their actual utilization is closer to 70%, they are going to generate permanently large unfavorable volume variances. The fix? You advise them to recalculate that POR using practical or normal capacity instead. Yes, this definitely means a higher overhead cost per unit on paper, but it finally reflects reality, which allows them to review pricing against corrected, honest standards. Section 4, Preventative Care, Internal Controls, and the Risk Register. We've spent time treating the failures, but a great financial physician stops the illnesses before they even happen. It really helps to think of preventative controls as physical objects. Think of them as gates and alarms. Preventive controls are the gates. They physically stop an error before it ever enters the records. For instance, requiring an approved requisition and a budget check before any purchase order is generated. Detective controls, on the other hand, are the alarms. They catch the error after it sneaks through. That's exactly what your monthly variance reports and your subledger to general ledger reconciliations are doing. They are the alarms sounding off before the financial period closes. I want you to sear this rule into your memory. A control with no risk is waste, but a risk with no control is exposure. You should always be able to name the specific risk that a control is defending against. If you're just doing paperwork for paperwork's sake, you are just wasting time. And that exact philosophy brings us to the risk register. When you look at unauthorized purchases, landed cost understatements, inventory shrinkage, and bill of material inaccuracies, every single one of these carries a massive impact. A bill of materials inaccuracy means your cost of goods manufactured is wrong, which distorts the product cost, which makes your entire variance analysis completely useless. The key here is to treat the root cause, not just the symptom. Your response to these risks is to build stronger gates and better alarms. Section 5, the health plan, prioritizing process improvements. All right, we've completed the diagnostic arc. Now we need to prescribe a prioritized, long-term health plan so the client can maintain their newfound financial integrity. You absolutely have to enforce these high-priority improvements first. You cannot build a fancy reporting dashboard if the foundation is rotting. Implement a strict landed cost policy to ensure valuation accuracy. Force them to update their standard cost annually, before the production year even begins, so that variance analysis is actually meaningful. Establish monthly variance thresholds so root causes are actually identified, and launch that ABC cycle count program for theft detection. Doing this closes the most damaging control gaps instantly. Another high-priority improvement that needs serious attention is LCNRV, or the lower of cost or net realizable value. This is a vital valuation defense mechanism. It absolutely must be assessed at every single reporting date, not just lazily pushed to year-end. If it isn't assessed timely, you run the massive risk of carrying an overstated inventory and artificially inflating those interim profits. Doing this ensures true balance sheet integrity by forcing the recognition of obsolescence reserves early on. Once that foundation is set, we move into the medium priority improvements. These are highly valuable. Things like implementing a perpetual inventory system for real-time shrinkage detection, classifying spoilage run by run, or building detailed gross margin analyses by SKU. But remember, they add necessary depth and precision only after the critical gates from our high priority list are fully secured. Look, if there is one overarching takeaway for you from this entire explainer, it's this. Treat the root cause, not the symptom. The variance report is one of the most powerful management tools in a business's arsenal. It is not just a bookkeeping requirement to get the books to balance at the end of the month. It's literally the language the factory floor uses to speak to the finance department. So I want to leave you with this final thought to take back to your own clients or your own business. When you dig into your next variance report and you push past the symptoms to finally find the root cause, will it reveal a simple clerical error or a calculated cover-up? The tools are now in your hands to find out. Thanks so much for joining me on this explainer, and I look forward to exploring more fascinating topics with you next time.